Hey, welcome back to Cost Accounting. Alex is here, that's me, and we're on Chapter 2, Accounting for Materials. So raw materials are a major concern of manufacturers. In this example, the Wall Street Journal Pepsi defense strategy, Pepsi commodities were rising in price, so Pepsi reported a 5% drop in the fourth quarter 2010 profit because of these rising costs. And so, the corn for their chips, the syrup in their drinks, crude oil for plastic bottles, and fuel for delivery trucks, and aluminum for cans all went up. And so they were having trouble passing those costs on to consumers. It wasn't having it. And its major competitor, Coca-Cola, doesn't have a sizable food business like Pepsi does. So it was less exposed to the commodities. And so the thing about that is dust. And so that's why on this chapter we're going to discuss materials control, internal control for procedures of materials, and adoption of a lean production manufacturing system to maximize efficiency and minimize waste. Very important. So basically for controls, you want to have material controls. So the physical control or safeguarding of materials and control over the investment in materials. So these include limited access to let's say to the inventory, segregation of duties, and accuracy in recording. So limited access means only authorized personnel should have access to material storage areas. So only a certain people should have the key to get into the storage, get the materials, and move them around. And if everyone has access, you don't know who's stealing or where is it going and whatnot. A segregation of duties is a basic principle of internal control where one person purchases, one person receives, one person stores the goods, another person uses the goods, and then another person records what all is happening. So the accountant. So you want to have those things segregated. And then we have an order point, which we'll do an equation on. This might be the problem example I do. So the order point is the minimum level of inventory should be determined. So the order point is when you should order more materials. Not how much. We'll get to that after. So basically, here's an example is, assume the company's expected daily usage of an item of material is 100 pounds. The anticipated lead time is 5 days. And the desired safety stock, so of the buffer inventory, would be 1,000. So you take 100 times 5, the time it takes to get it, which will give you 500 pounds, plus the 1,000 pound safety stock, gives you an order point of 1,500. So basically, you need to order when the inventory gets down to 1,500. That's when you want to order, because let's say you use 100 pounds a day. You want to make sure you don't run out of the safety stock you have before you get the new stuff. And it's always good to have a buffer because let's say there's a delay, there's a storm, the supplier is out of inventory for a short period. You want to have a buffer to where you'll at least be able to keep producing materials. You don't actually have to shut down all the production. So the order point is the minimum level of inventory on hand that you can have before you order more goods. And that's important because now we have the economic order quantity, which is exactly how much to order. So the economic order quantity, so the order point was daily usage times lead time plus safety stock equals order point, when to order. And then economic order quantity is the square root of 2 times the cost of placing the order times the number of units required annually divided by the annual carrying cost per unit. And I could show an example of that one too. I might just do order point and economic order quantity side by side. Okay, materials control procedures. So the purchase and receipt of materials, the storage of materials, and the requisition and consumption of materials should all be segregated. You should have a purchasing agent, a receiving clerk, a storeroom keeper, and a production department supervisor. So the purchasing agent is in charge of buying the goods. The receiving clerk is responsible for receiving the shipment and checking it in. The storeroom keeper should keep the materials locked up and stored and maintained properly. And the production department supervisor should know when they're going to need more requisitions to purchase. So the production department supervisor will see what the production floor needs, and then he'll make a purchase requisition so that the purchase agent can start buying. So the production floor will make a purchase requisition. The purchase requisition will go to the purchasing agent, who will make a purchase order to the vendor. The vendor will then send an invoice, and then the receiving clerk will make a receiving report once he gets the goods. And then, of course, you have debit and credit memorandums, which are just if you had to return something or if something was defective. So it goes, the storeroom guy will say, oh, we need more stuff. The production needs more goods. So the purchase agent will buy from the vendor, who the vendor will send to the receiving clerk, who the receiving clerk will make a report, and the accountant records the whole process, kind of oversees everything and collects all the data and compiles it into the system. So those are the required forms. And then it goes into, on this chapter, it does some FIFO, some LIFO, some weighted moving average, which I think we went over that in 201. But if you need help, you can ask him the question. But it didn't really change too much. It's still the same concept, so we'll go over that. We'll keep moving. Okay, there's a just-in-time inventory production system, or the lean production system. So it's when you order things and they get there just in time to replace the old stuff that just got sold, because you don't want to have, the problem with having too much inventory stocked is it costs you money to store it, protect it, and to just keep it from going bad. Sometimes it gets outdated or it ages and whatnot. So you don't want to keep too much inventory on hand. You want to keep it lean. You want to keep just the right enough inventory that you're going to use it right away. Otherwise, send the overflow back to the supplier. Get your money back. So the push manufacturing system is very traditional. It's where you overmake things, and you hope that you create demand, because you made so many of something that you hope that people will demand it. But the better one is the pull manufacturing system, which the credo is, don't make anything for anybody until they ask for it. And it's very successful because you make things just as people need it. So you don't make something until the supplier says, hey, we need more of this. Then you make it, instead of making a whole bunch and pushing it onto the supplier and saying, here, work with this. And so the differences between the pull and the push. Throughput time is velocity. So, for example, if 10,000 units are produced each day, and the average number of units in work in process is 40,000, then the throughput time is 4 days. So 40,000 divided by 10,000 equals 4 days, which is perfect. But if you were able to lower the work in process, the average work in process, by 30,000, and it was 10,000 divided by 10,000, then the velocity for which a unit is produced in the system will only be a day. It'll go from 4 days to 1. So you can see how you can speed up production. Okay, and then we have some backflush costing, which we'll have to do, which is it's actually a lot easier, less journal entries. So here, when you purchase raw materials, instead of throwing it into materials, instead of debiting materials, crediting accounts payable, you're going to debit raw and in process, and you're going to credit accounts payable. And then when you put the raw materials into production, there's no entry, because raw and in process takes the place of both those entries. Direct labor and factory overhead. Instead of dumping it into work in process and factory overhead, how you dump payroll into work in process, you dump various credits into factory overhead. You're going to dump payroll into conversion costs, and you're going to dump the various credits into conversion costs. So conversion costs replaces work in process and factory overhead. So the direct labor costs and the manufacturing overhead are just all combined. And then when you transfer factory overhead to work in process, there's no entry on the back flush. But the completion is, instead of having work in process go into finished goods, you're going to have raw and process and conversion costs go into finished goods. And the sale of the products are the same. Cost of goods sold gets debited, finished goods get credited. Okay, then we have scrap, spoiled goods, and defective work. So scrap is when scrap value is small, no entry is made until the scrap is sold, at which time the following journal entry will be made. You debit the cash, credit scrap revenue. That's only when it's sold. Now, if the value of the scrap is high, like maybe it's a iron scrap, gold scrap, silver scrap, you can actually debit scrap materials, credit scrap revenue, and then when you sell it, debit the cash, credit scrap materials. Different ways to account for it. Spoiled and defective work. So spoiled work means are usually seconds. So there's something wrong with them that wasn't worth fixing, and they'll just sell it as a secondary item. So 50 jackets are found to be inferior, but they'll sell for $10 each. If we had to pay $50 to make them, we lost a little bit, but we make some of the money back. So if the total cost per unit for us is 50, but there's 50 jackets that are bad, and we're going to at least get 10 back, we're going to debit spoiled goods inventory for the 500 that we're going to make, debit factory overhead for the 2,000 we've lost, the other $40 we can't get back, and then credit it all to work in process. It's going to be for the 2,500. It's a really rainy day today, too, by the way. Another rainy day in Washington. This is Washington that I'm in. And then now if you this version is only used factory overhead as if you can't narrow down who caused the cost. But if you can, then instead of doing the factory overhead for 2,000, throw that out. Debit spoiled goods inventory, credit work in process 500, and you can basically take the cost out of the work in process and dump them into the spoiled goods inventory. That's if you can narrow down who costs what. And then defective work. Defective work is when you made something wrong the first time and you're going back to fix it, which will cost some, but usually it's worth the cost on this part. So you have, if you have 1,000 jackets and there's defects in all of them, and it costs you for the 50 jackets, 500 for materials, 400 for labor, 300 for factory overhead, representing 1,200 in cost. You're going to debit factory overhead for the $1,200, credit materials for the 500, credit payroll for the 400, and credit factory overhead for the 300. And that's going to be what you're going to charge extra cost for preparing. Now, if you can narrow down the job, once again, instead of doing just debiting into factory overhead, you're going to debit it into work in process. And that's the difference. That was chapter 2, quick explanation. And I'll do some examples, but that's the meat of the chapter. And I know I make it sound kind of easy, but it is if you just keep an open mind and you do the homework and you listen to the lectures, go to class, read the book, and I hope these videos help. And I'll do a few examples on order point, economic order quantity. And so I hope this helps, and I'll be back. I'll do the example in the next video for chapter 2, and I thank you. If you have any questions, feel free to ask, but I hope this wraps it up. So I'll see you next time. Yeah.